Legislative Update, featuring Acting Director of Policy Implementation and Oversight, Ian Foss.
Hi, everyone. Thank you so much for joining me today to listen to my presentation, which is a legislative update. At this presentation, we will be covering all of the legislation that has passed and one piece of important legislation that has been proposed since we last met with you in December of 2019. So let's start by talking about the various pieces of legislation that we're going to cover today. In particular, there are two appropriations bills or laws that we need to talk about. And for those of you who maybe are new to the financial aid industry, the appropriations laws actually influence the amount of aid in certain programs that students can be eligible for, and sometimes also modify or affect eligibility for the programs themselves. We're also going to talk a bit about the Future Act, which is a law that I know that a lot of you are excited about, and I'm going to provide a brief status update on where we are in terms of implementation of that law. And then I'm going to close things by speaking about the Student Loan Repayment and FAFSA Simplification Act, which, although it has the word act in the name, is still a bill. It has not been passed into law yet, but it is significant enough that we want to spend some time talking about it today. So we're going to start with the FY 2020 Appropriations Law. This is the Department of Education Appropriation Act for fiscal year 2020, which passed back in December of 2019. Among other things, the fiscal year 2020 Appropriations Law, sets funding levels for various federal student aid programs. So what you see on this slide is a table that walks through the funding levels for the Pell Grant, the Federal Supplemental Educational Opportunity Grant, and the Federal Work-Study Program. And what you can see here is that there has been not a lot of movement in terms of the amount of money that has been appropriated. There is small increases to the FSA and Federal Work-Study programs. And the Pell Grant program itself, there was no change in the amount that was appropriated. Though with respect to the Pell Grant program in particular, it's very important to bear in mind that the federal Pell Grant program is actually funded fully through a mix of what are known as discretionary funding streams and mandatory funding streams. And so just one small lesson about the difference between the two. Discretionary funding streams are things that are appropriated on an annual basis by Congress in its fiscal year appropriations, whereas mandatory funding streams are funding that is provided through the normal sort of how a bill becomes a law process. Congress passes a law and then we implement it. That's where the mandatory funding comes from. And so the amounts reflected here are only those that were made available through the FY 2019 and FY 2020 appropriations law, which is the discretionary funding streams. So for the federal Pell Grant program in particular, what you see on this slide is not the sum total of the funding that's been made available for the program. Ultimately, we take these two funding streams, add them together, and run a series of calculations to determine the federal Pell Grant payment schedules. And based on the fiscal year 2020 appropriations law, the maximum Pell Grant for the 2020-2021 award year was $6,345, which was a $150 increase from the prior award year's $6,195. This is actually the first time that we'd seen an increase in the federal Pell Grant for a few years. It had been static for a while, but the 2020-2021 award year did see an increase for the first time in a little while. As I'm sure you all know, every year we publish Dear Colleague letters that lay out the federal Pell Grant payment schedules, and those Dear Colleague letter references are available to you on this slide. In addition to the funding for our programs, the appropriations laws for a given fiscal year also give federal student aid its budget. And so actually for fiscal year 2020, Congress appropriated over $1.7 billion to federal student aid to carry out its programs. Some of that money is specifically carved out for salaries and expenses. That's the $911 million figure. And then the remaining portion of that is actually left for what we all know to be loan servicing. And that's $857 million. So on a given fiscal year, Congress actually appropriates almost $1 billion to support the collection of federal student loans that we own. It's interesting to note that the funding level for fiscal year 2020 represented a $90 million increase over the prior fiscal year, but was still over $43 million less than the amount that was reflected in the executive branch budget request to Congress. And so what this is saying is that though we certainly saw an increase in the amount that was appropriated, and we're certainly grateful for the additional money that has been appropriated so that we can carry out our programs more effectively and efficiently and provide higher quality services, we still receive less money from Congress than we think is necessary for us to do the best possible job. And so, as it relates to loan servicing in particular, the fiscal year 2020 appropriations law also contains a number of servicing provisos. And a proviso is an element of an appropriations law that controls or limits how appropriated funds can be used. So, for example, Congress may say, I am appropriating $100 million for you to spend on implementing the 150% direct subsidized loan limit, which you all know and enjoy implementing every single day. They may then say, however, you may only spend that $150 million in the following ways, or you must ensure that when you are spending that $150 million, you must do the following things. And so in fiscal year 2020, there were actually 10 servicing provisos attached to the money that Congress appropriated. And so what you see on this slide is a representative sample of the provisos that are specific to the next-gen FSA contracts that we are currently working to award or have awarded and are now working to implement. So, for example, there is a ban on us awarding a servicing contract to a single servicer with some limited exceptions related to what we call specialty servicing. Next-gen contracts related to loan servicing must provide incentives to provide additional support to borrowers who are at risk of delinquency and default. And contractors must specifically have the ability to meet service levels. And you can think of a service level as you must process a request for a deferment within 10 days of receipt. They must be held accountable for compliance with consumer protection laws, and they must have demonstrated relevant experience and effectiveness. But those are just some of the provisos. There are other provisos that were provided in the FY 2020 appropriations law that affect our current servicing contracts. So, for example, borrower accounts have to be allocated among all of our servicers based on common performance metrics. Believe it or not, this was not always the case. There used to be different performance metrics depending on whether or not a servicer was one of what we call our TIVAs or Title IV additional servicers, or one of our not-for-profit servicers that receive contracts under a different vehicle. Because of these provisos, now all of our servicers are held to the same performance metrics. In addition, when borrowers consolidate their loans, they traditionally have had an opportunity to choose the loan servicer that would service their new consolidation loan. Previously, not all of our servicers were among the list of servicers that a borrower could choose when consolidating their loans. But as a result of this proviso, that is now the case, and in fact has been the case for a while. Although these provisos appear in the FY 2020 appropriations law, this is not the first time that these provisos have appeared. And so many of them have actually been implemented for some time. And the consolidation proviso is one of them. In addition, servicers must be evaluated based on their ability to meet requirements, subsequent performance, and compliance with consumer protection laws. Reallocation of accounts must occur based on recurring non-compliance with laws, regulations, and contract requirements. There are additional transparency requirements related to servicer performance, And if we do permit subcontracting, we must hold the prime contractor accountable for the conduct of the subcontractor. So that is loan servicing in a nutshell, frankly, as it relates to the amount of money that is appropriated and the limitations on how we can spend that money. There were also other provisos in the fiscal year 2020 appropriations law that relate to other aspects of our programs and indeed even some other aspects of loan servicing. So Perkins servicing is an example in what you see on this slide. The FY 2020 appropriations law permitted, but does not require, student aid administration funding to be used to reimburse Perkins schools for loan servicing costs. Now, it's important to bear in mind when you hear me say that this is in fact quite different from the reimbursement process for Perkins service-based cancellations that we've now been doing for a little while. This is a completely separate provision, a completely separate authority, and a completely separate type of reimbursement. And it's very important to understand that though the law permits the money to be spent in this way, it does not in fact require that it be spent this way. In addition, for fiscal year 2020, specific schools were offered a waiver of cohort default rate requirements. So from October 1 of 2000 and for 2 years, in fact, the fiscal year 2020 appropriations law waives the consequences of cohort default rates for schools that meet the following 3 criteria. They need to be public associate degree granting institutions. They need to be economically distressed. And as you can see, based on that asterisk, that is a term that has a specific definition. And they need to have been a school that was impacted by Hurricane Matthew. And so if you look down at the bottom of the slide, you can see that the definition of what it means to be economically distressed was in fact quite specific. It's an economic, it means a poverty rate of at least 25% based on the US Census Bureau's small area income and poverty estimate program data for 2017. It really doesn't get more specific than that. And so we have identified so far the schools that meet these criteria and granted the waivers to them as appropriate. And of course, the authority for this waiver in particular is coming to an end in the near future. But we will see what, if any, other waivers Congress provides through appropriations laws or other laws. Of course, for public service loan forgiveness and temporary expanded public service loan forgiveness, most of you have been tracking this for several years, but Congress has set aside through the FY 2020 appropriations law an additional $2.3 million from the Student Aid Administration funding figure to conduct outreach for borrowers related to public service loan forgiveness and temporary expanded public service loan forgiveness. And these provisions of the FY 2020 appropriations law have actually been around for several years. And so Congress has actually been adding to prior appropriated or set aside amounts. And so now between this last fiscal year's appropriation and the prior fiscal year appropriations, Congress has now set aside a total of $6.9 million for us to conduct this outreach. And the outreach that we're talking about here is ensuring that borrowers fully understand the eligibility requirements for PSLF and in particular TEPSLF, as well as conducting targeted outreach to borrowers who appear to meet the eligibility criteria for TEPSLF. And so that outreach is ongoing and will continue certainly until the set-aside funds are exhausted, and will likely continue even after those funds are exhausted. But for temporary expanded public service loan forgiveness in particular, Congress appropriated an additional $50 million to support forgiveness under the temporary expanded public service loan forgiveness or TEPSLF opportunity, and increase the forgiveness cap by $75 million. If you're not very familiar with temporary expanded public service loan forgiveness, or you just want to learn more about the program, I highly recommend that you attend breakout session 16, where we talk about both PSLF and temporary expanded public service loan forgiveness. You are very likely to see my face presenting when you hear that session. So I'll go into a little bit more detail about the appropriated amounts and the forgiveness caps for temporary expanded public service loan forgiveness now. But there are basically 2 requirements that need to be met for temporary expanded public service loan forgiveness. There's an appropriated amount of $750 million in total, and there's a forgiveness cap of just over $1 billion. And the appropriated amount actually seeks to measure the amount of foregone revenue that would no longer come into the federal government as a result of forgiving a loan that would not have otherwise been forgiven if Congress hadn't have created this program, which is separate from the actual nominal dollar amount that is being forgiven. So for example, if I receive TEPSLF in the amount of $40,000, that doesn't necessarily mean that the government is going to lose out on $40,000. You also have to consider things like the future interest that would have accrued, the current and future value of the payments that I would have made on that loan before either receiving public service loan forgiveness or paying the loan off in full. And so these two figures are tracked separately for that reason. And through the FY 2020 appropriations law, Congress has actually raised both of those caps yet again. We'll now talk briefly about fiscal year 2021 appropriations. And I will say that we are going to talk about it briefly because we do not have a full fiscal year's appropriation yet. We're currently on a continuing resolution, or CR. We're recording this on November 18th of 2020, and we currently have funding that is set to expire in mid-December, on December 11th in particular. The continuing resolution maintains everything from FY 2020 at flat funding levels, and there are no new provisions that were contained in the continuing resolution that would modify our programs or how we operate them. And so we are currently waiting to see whether and when Congress appropriates money for fiscal year 2021. And now we are going to talk about the impact of us not having a fiscal year 2021 full appropriation yet. There are two primary programmatic effects. The first is that we can't actually calculate Pell Grant payment schedules until we have an appropriation for the full fiscal year. And we also cannot complete the calculation of campus-based awards until we have an appropriation for the full fiscal year. Nevertheless, the Higher Education Act, or HEA, requires that Pell Grant payment schedules be published by February 1st, and that campus-based awards be published and provided to schools by April 1st. And so the longer it takes for us to receive a full fiscal year appropriation, the less time we have to meet our statutory obligations to calculate Pell Grant payment schedules and provide campus-based awards for the upcoming award year. And so, as always, as soon as we have an appropriation for a full fiscal year, we'll immediately get to work calculating those things and publishing them. But right now, we continue to get questions about when we'll get Pell Grant payment schedules for the upcoming award year, and the answer is we have to wait and see. Now we are going to talk about the Future Act, or the Fostering Undergraduate Talent and Unlocking Resources for Education Act. Personally, I prefer Future Act because it's less of a mouthful. This law actually passed right after last year's FSA conference, December 19th, 2019. So we were all anxiously watching Congress while we were at the FSA conference last year to see whether or not they would actually pass the Future Act, and they did. And we're excited about it. The Future Act does three things primarily. Right now, as you all know, we have an IRS data retrieval tool that connects the free application for federal student aid, or FAFSA, to the IRS and allows applicants and their parents to import the information that they have on file with the IRS into their free application for federal student aid, which for those who can use it makes the process quicker, easier, and more accurate. The Future Act seeks to automate this data exchange so that the need to go through, more burdensome authentication mechanisms and click many buttons in order to transfer data back to the FAFSA from the IRS happens behind the scenes and without the intervention of the applicant. So, for example, when an individual is completing a FAFSA, their IRS information would automatically, hopefully, appear or automatically be populated into their application. So that's one purpose of the Future Act. The second relates to income-driven repayment plans. These are repayment plans that base federal student loan payments on income and family size instead of more traditional characteristics like loan debt and interest rates. The current state of affairs for income-driven repayment plans is quite similar to the FAFSA, where an individual borrower and sometimes the borrower's spouse need to go to our website every year and use the IRS data retrieval tool, authenticate, and populate their income-driven repayment recertification application with information from the Internal Revenue Service. And the Future Act seeks to eliminate that barrier by automating that data exchange and removing the obligation of the borrower to intervene in the process on an annual basis to have their payment amount calculated. And the last purpose, primary purpose of the Future Act, it relates to total and permanent disability discharge, or TPD. This program forgives the balance on loans for individuals who are totally and permanently disabled. But depending on the type of documentation that a borrower submits in order to confirm eligibility for a discharge, they may be subject to what we call a 3-year post-discharge monitoring period that seeks to confirm that the individual truly is unable to engage in gainful employment, earn wages above a specific threshold. And right now, individuals receive a paper form every year that they have to fill out and mail or fax or email back to one of our vendors in order to have their continued eligibility for discharge confirmed for that 3-year period. And the Future Act seeks to eliminate that barrier as well, so that for at least a certain subset of individuals who are subject to this monitoring period, they will no longer be obligated to intervene in order to confirm their continued eligibility for a discharge. Before we talk about security requirements, it's really important to understand that the Future Act actually is very specific about the data items that can be exchanged between federal student aid and the IRS. And what you see on this slide is the list of data elements that is allowed to be exchanged under this law for the FAFSA. So identifying information, filing status, adjusted gross income. You can read this slide for yourself. I'm certainly not going to read all of it to you. The point of me bringing this up is that this law is very specific. And so should, for example, the need analysis formula change and the Future Act not be updated in order to accommodate that, then we don't necessarily have the ability to automatically update our data exchange with the Internal Revenue Service to reflect the change in the need analysis formula. Similarly, other information that might be interesting to know that the IRS has on file, but that is not part of these data elements, cannot be exchanged as part of the solution under the Future Act. So again, this is a very specific law. It's also important to understand, related to the Future Act, that with respect to FAFSA information in particular, that information can be redisclosed to schools, state education agencies, and certain scholarship granting organizations. And when the Future Act passed, all parties receiving what is called federal tax information, which is to say the information that is exchanged between the IRS and FSA under the Future Act, would need to become compliant with the security requirements of IRS publication 1075 and hold that information in the strictest of confidentialities. Now, when the CARES Act passed earlier this year, that law actually modified those security-related provisions of the Future Act such that schools, state education agencies, and certain scholarship granting organizations are no longer required to be compliant with these IRS security requirements. But the reason I bring this up is because there is still a great deal of interest among members of Congress about the level of security that schools and similar organizations will be held to when they receive this type of information. And so just because the CARES Act eliminated the requirement to be compliant with IRS publication 1075 does not mean that we will not see some degree of stricter standard that is created through some subsequent bill. And of course, because I have mentioned the CARES Act, I would be remiss if I did not point you all to General Session number 5, where you can get a whole host of additional and more detailed information about the contents of the CARES Act that law really did far more than modify the Future Act. It did a whole host of things, and you can learn more about it in General Session 5. In terms of our implementation plan, we're obviously working towards a phased approach, as you can see on this slide. This is a notional timeline, and I say notional because it means that this is our current tentative plan, and that plan may change as we work towards implementation. So starting in the fall of this year, we're working to implement a TPD post-discharge monitoring simulator and to digitize that form and process to set us up for the exchange between the IRS and FSA to support TPD. So that's happening first. Next, we plan to work on implementing a Future Act-enabled simulator for the FAFSA form, which will do nothing more than allow us to gather feedback from students and families about the new experience that they can expect after the Future Act is fully implemented. And we'll use this feedback to tailor our implementation strategy to the needs of our customers. And then in fiscal year 21 through 22, we will fully work towards implementing the Future Act through the full implementation of all three of the primary purposes of this data exchange that I laid out earlier: total and permanent disability, income-driven repayment, as well as the Future Act-enabled FAFSA solution, which we hope to launch with the start of the 2023-2024 FAFSA. And so to wrap up my presentation, I wanted to spend a few moments talking about the Student Loan Repayment and FAFSA Simplification Act, which was introduced this summer. This is still a bill. It has not passed into law, but we are continuing to monitor its progression through Congress and want to alert you to some of the provisions of them now, should this law pass. Starting with the student loan provisions, these provisions would actually apply to a student who takes out a new loan on or after the date of enactment, or seeks to change repayment plans after the date of enactment. And ultimately what this does is it simplifies the repayment landscape for federal student loans. You all have heard me probably present for years on the complicated nature of student loan repayment. We have very many repayment plans that have been added and tweaked over time, and it can become very confusing for borrowers. So this law would simplify things such that there are two repayment plans: a standard repayment plan with fixed payments and an income-determined repayment plan, or IDR plan. So we'll have to rename our current catch-all income-driven repayment plan to some repayment plan terminology to something else if this law passes. But this law would generally set income-determined payments at 10% of discretionary income. It would seek to phase out discretionary income exclusions as income increases. It would provide forgiveness after 20 or 25 years, depending on whether or not the student borrowed for graduate school. It would not alter the fact that forgiveness is taxable. It would eliminate interest subsidies that currently apply to some income-driven repayment plans. It would not be available to Parent Plus loans, even if those loans are consolidated into a direct consolidation loan. But these payments would continue to count towards PSLF. And what's important to understand about PSLF in particular is that borrowers pursuing PSLF through this new income-determined repayment plan will actually lose credit towards PSLF if they ever leave the income-determined repayment plan, which is different from things how operate today. And finally, we should talk about the FAFSA provisions. It's best to think about these provisions assuming that the Future Act has been fully implemented. Importantly, the expected family contribution would be renamed to the Student Aid Index to calculate eligibility for need-based aid, except for the Pell Grant. The Pell Grant would now have a completely different formula associated to how eligibility is calculated. In fact, the EFC was not established until 1972 in the HEA, and we actually called it something similar to Student Aid Index. We called it the Student Eligibility Index until the 1984-85 year. Student Aid Index would be a greatly simplified form of the expected family contribution formula. It would only include on the income side information that's available from the IRS through the Future Act, and it would change what counts as assets and how assets are treated. The student aid index could actually be a negative number, but that number would be treated as zero for awarding purposes. And the auto zero student aid index treatment would only be available to those who do not file a federal tax return. The Pell Grant provisions in particular are important to understand because they operate differently than they do today. So right now, the EFC dictates the amount of a Pell Grant that a student can get. But moving forward, should this become law, the Pell Grant would instead become a function of the individual's adjusted gross income and the applicable poverty guideline that happens to apply to that student. So there's a simpler formula going forward for Pell Grants should this bill become a law. And that really is it. That is what Congress has been working on over the course of the last year, setting the Future Act aside for the CARES Act aside for the moment. Please attend General Session number 5 if you would like to learn more about the CARES Act. And I would like to thank you all very much for spending 30 minutes of your time learning about what Congress did in the year of 2020. Thank you.